Hi, I Jatin Visaria welcome you on behalf of UTI Mutual Fund. Globally, passively managed index funds and exchange traded funds, that is ETFs, are very popular. In India also, in last few years, index funds and ETFs have grown not only in terms of asset under management but also in terms of number of schemes. Currently, there are more than 120 index funds and ETFs available in India. And out of this, around 100 schemes are replicating various equity indices. Thus, it is important to know what factors and which parameters one should consider while selecting and investing into these type of schemes. So today, we are going to talk about tracking error, cost and size, which are three critical parameters while selecting these type of schemes. Let us start with tracking error. The investment mandate of passively managed equity index funds and ETF is to replicate or track underlying equity index. Any deviation or error in such tracking is called as tracking error. It basically reflects how closely and how consistently the scheme is able to replicate its underlying total return index. Near to zero and low tracking error shows and reflects the consistency and efficiency of managing the scheme. The another critical aspect is the cost. Total expense ratio, that is TER, and investment related transaction expenses are two types of costs investors should ideally consider while investing into index funds and ETFs. Low TER translate into the cost saving and thereby may help in enhancing the scheme returns. In addition to TER, investors should also consider the transaction cost associated with the investment. Broadly, in case of index fund, largely all costs are reflected into the net asset value, that is NAV of the scheme, and in general, investors are not required to pay any additional costs separately. However, in case of ETFs, investors should also consider the transaction cost like trading brokerage, liquidity provision cost, demat account charges, etc., which are normally paid over and above NAV of the scheme. Lastly, the asset under management, that is AUM or size of the scheme, is also important. Relatively large size helps in efficiently managing the scheme. To sum up or to summarize, the tracking error, cost and size are three critical parameters investors should evaluate while selecting an index funds and ETFs. The fund having low tracking error, low cost and relatively large size may be the prudent investment option. For more detail, you may like to visit our website utimf.com. You can also post your queries or questions in the comment or reply section below. Thank you for listening and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.